What's up, everybody? My name is Joe Brown, and this is Heresy Financial. Have you ever been looking through a list of stocks and just thought to yourself, man, I wish stocks paid higher dividends? In fact, it used to be that dividends were pretty much all investors cared about. If you were sitting down with a financial advisor and they recommended a stock to you, your first question would be, how much does it pay? Compare that to today, the most common question. If an investment advisor recommends a stock to you, you're probably going to ask, how much does it grow? Now, I fully understand the business advantages to plowing all of your revenue back into your business for growth. But the idea of that, and the reason shareholders typically historically reward that type of business behavior, is because someday in the future, they know that the profits the company makes will then be returned to shareholders at a greater amount. That's low time preference behavior where you're sacrificing return on your money, cash flow in the present, for the anticipation of larger returns in the future. On the other hand, investing in dividend-paying stocks specifically to maximize income on your stocks is trying to invest in companies that are currently rewarding shareholders, because when it comes down to it, earning dividends off of your stocks, having the business produce profit that it distributes to its shareholders, that's the only way to make money in the present on the stock, rather than hoping you can sell it to somebody in the future or hoping there will be future distributions of profits. Cash isn't king, cash is trash, but cash flow is king. If you invest in real estate, your cash flow comes from tenants paying you rent. If you invest in stocks, your cash flow comes from dividends. But many stocks these days pay paltry dividends, especially in the US, to the point where some of the most popular dividend-paying stocks actually pay less than treasuries. So what's the solution? Well, let's look at 3 strategies that you can use to massively boost the income you're making on your dividend income stock portfolio. Ready? Let's dive in. You knew this was coming. Customary disclaimers here. Number 1, obviously, this is not investment advice. This is not a recommendation. Not only because I don't know you, but also because some of these strategies are intermediate to advanced strategies. And if you don't know what you're doing and you try and utilize these strategies without doing your research and without understanding what you're doing, you could be increasing the risk on your portfolio and exposing yourself to potential massive loss. And especially given the current macroeconomic environment, these strategies may be tools you want to stick in your tool belt and wait to use until we get some sort of a market correction, maybe the record high margin usage of retail stock brokerage accounts goes down a little bit, valuations of stocks recede from these crazy extreme valuations, historically speaking. So even if these are strategies you want to try out, they may be things that you might want to just sit on and wait until a more appropriate time. Okay, so what are they? First strategy, find better companies. Yes, you've heard of Procter & Gamble. Yes, you've heard of Johnson & Johnson. Yes, you've heard of McDonald's. Guess what? These aren't the best stocks to invest in if your goal is to maximize dividend income. They might be fantastic companies, but if your goal is current income, it's not going to cut it. Now, you can start with looking at the dividend aristocrats. This is a very popular entry method to dividend investing. If you're not aware, a dividend aristocrat is a company that has paid dividends consistently and increased them every single year for at least 25 years. Now, if you're going to start off with looking at the dividend aristocrats to invest in for this strategy, you might want to consider this more of a long-term approach, because you're probably going to be looking at 2%, maybe 3% for a lot of these companies. And over time, they will probably grow. And so the income you'll be making on your actual investment, let's say you put 100 grand in, it pays 2% right now. And in 10, 20 years, it's worth 200 grand and it's still paying 2 or 3%, but that's 2 or 3% on 200 grand, and you've only still invested your original 100 grand. Eventually, your return on your invested money will go up. But the dividend aristocrats are really not going to be something that's going to maximize your current investment income. So what other companies are there? Well, you can look at standard high dividend ETFs, things like SPYD, which invests in high dividend paying companies that are already part of the S&P 500, and currently this ETF pays 4.79%, or ETFs like DEM, which invests in high dividend paying companies from emerging markets, and this one pays about 4.5%. Again, not life changing, but a lot better than 2 or 3%, better than a 30-year treasury. What other options are there? Anything better? Well, I'm glad you asked. You can look at REITs, real estate investment trusts. Many of these real estate investment trusts pass a lot of their income through to their shareholders. Companies like WPC, WP Carey, or Care Trust Realty. These two companies are paying 4.5% and 5.5% right now. And if you want to take one more step up from there, you can look at business development companies. Business development companies are specifically designed to pay high dividends. Examples of these would be Ares Capital, ARCC, or New Tech Business Services, NEWT. These two each pay just around 8%. You can also look at covered call ETFs, which are essentially just investing in a list of stocks that are normal, like the NASDAQ or the S&P 500, and then the ETF will systematically sell calls on the portfolio to produce income on those stocks. An example of this would be QYLD. QYLD is an ETF that invests in the NASDAQ, sells calls, and right now it pays 11.7%. Now again, all of these symbols and stocks and companies that I mentioned, they're just examples, but I wanted to kind of broaden your horizons here so that you can see there are different sectors, different industries, different types of companies out there that invest in order to pay high dividends, and dividend investing isn't dead. These companies still exist, and these are, as of the date that I'm recording this, these are all the current annual dividend yields for these stocks. Now, you probably wouldn't want to go all in on something that pays 12% just in case something happens to that specific fund. If there's a flaw in their strategy, you probably want to be a little bit diversified, which means that your overall portfolio income, if you choose some of these higher quality, let's say a basket of 10 to 15 or maybe even 20 of them, let's say you're earning 5, 6, 7, or 8%. Better than inflation, but still not amazing. So that's where strategy 2 comes in, where you really start to juice your returns. And I know it sounds crazy, but just stick with me to the end because it'll start to make sense. This strategy is to use margin. Here's why this works. Let's say you build yourself a basket, a high dividend income portfolio. Some of them are higher than others. You've got 15 in there and it's paying you on average, let's say just 5%. If you throw $100,000 at that, that's going to pay you $5,000 every year. Now, let's say you find a broker. This is the key. You find a broker with a low margin rate, because you can take your $100,000, get 5% on that and make $5,000 a year. Or if you take your $100,000 and use a margin loan in order to buy $200,000 worth of that portfolio, you still only got $100,000 of your own money invested, but now your portfolio is worth $200,000 because you borrowed $100,000 in order to buy more. Well, each individual investment still pays 5%, but now you're making 5% on $200,000 instead of 5% on $100,000, which means your income from your portfolio is now $10,000. That means that your income on your $100,000 investment is 10%. It's the power of leverage. And I know what you're thinking. But you forgot about margin costs. And that is exactly correct. So let's walk through that, because you don't get to keep that full $10,000. You have to subtract the margin interest rate, because you've got a $100,000 loan that you're paying interest on. Now, if you go to a standard discount broker out there, many of them are going to charge you 5, 6, 7, 8, 9%, depending on your margin balance, which means that if your margin interest rate is 6%, that means you're paying $6,000 per year on your margin loan. Well, you're only bringing in $10,000. That means you're left over with $4,000, which is worse than you would have done if you would have just used your own $100,000 and left it there. You were bringing home 5. Now you're only bringing home 4. That's a bad deal. You're increasing your risk and you're reducing your income. However, let's say you're paying 3% for your margin interest rate. That means every year you're paying $3,000 on that $100,000 loan. Well, now you're taking home $7,000 a year. That's better than the $5,000 that you were before. So including margin interest costs, you're making 7% on your invested money, whereas before, if you just used your own money without using any leverage, you were only making 5%. This means that obviously the lower margin rate you can find, the better your returns are going to be. 2 examples of brokers that are pretty much polar extremes, but offer good margin rates. One of them is going to be Interactive Brokers. They've got fantastic margin rates. Depending on your account type and your margin balance, you can get anywhere from 0.75% annually to 2.58% annually. They've got an extremely wide range of products. You can invest in global stocks, options, futures, currencies, bonds, plenty more. So those are the pros. The cons are, it's a really terrible user interface, like absolutely horrible. Almost like it was built 20 years ago in a competition for the worst platform ever. So they've got a wide range of features, so you can basically do anything you want, and they've got the regulatory minimums for everything. They don't have any of their own imposed rules on top of regulatory minimums. So it's a great platform for that. It's just hard to figure out how to do what you want to do. Terrible website. Now, the polar opposite of that, you've got M1 Finance. Again, they've got really great margin rates. Depending on the account type, you're either going to get 2% or 3.5%. You can invest in most stocks and ETFs, and the platform is extremely easy, very intuitive, fantastic user interface. So those are the pros. The cons are it's very, very limited in what you can do with the portfolio. Basically, what you're doing is you're selecting the stocks or the ETFs that you want. You're assigning a percentage to each that you want it to make up for your overall portfolio. And then any money that goes into the account automatically gets invested according to the percentage allocation that you've set. You're not going to be trading with dollar amounts. All you're doing is setting up an automated portfolio, kind of setting and forget it. So it's extremely easy, but extremely locked down. So these are both extremely low margin rate options, kind of polar opposites depending on what your preference is, what you want. If you want the ability to basically invest or trade anything you want with as little restrictions as possible, and you don't care about a bad user interface, Interactive Brokers is for you. If on the other hand, you're looking for the easiest way possible to set it and forget it and use a very low margin rate, and you don't care about a wide set of features, you just want to set up your allocation and let it run for you, M1 Finance is for you. I've got both of them linked below. Okay, the third strategy that you can use to boost your income on your portfolio is going to be selling calls. Now, you heard me mention covered call ETFs earlier, so I'm going to explain that now, but this is something that you can actually do yourself instead of relying on an ETF to do for you. The first thing is you have to teach yourself how to use options. So this is why I said earlier that some of the strategies could open you up to a lot of risk. This is one of those reasons, because if you do it wrong because you don't know what you're doing, you could blow yourself up. If you want a simple, straightforward guide to learning how to use options, I've got a beginner's course and an advanced course linked in the description below. But basically a covered call ETF, they're going to take a basket of stocks, and usually they're just going to write options. They're going to sell calls on the index that those stocks are a part of. So QYLD, it invests in the stocks that are in the NASDAQ, and then they just sell index options. They sell calls on the NASDAQ. They don't sell the calls on each individual stock. Now, a call gives the buyer of the call the right to buy that stock at a specific price during a specific time. This means that the seller of that call now has the obligation to sell those shares to the call buyer at that specific price during that specific time frame. Now, that right that the call buyer has to buy those shares doesn't come for free. They have to pay the call seller for that right. Here's an example. If you own Apple and you bought Apple at $130 per share, you can sell calls on Apple for next month. They'll expire in a month at a strike price of $140. You would sell that right now at a price of $5.40 per share, and every option is 100 shares. So you'd get $540 in order to give somebody the right to buy Apple shares from you at $140 anytime between now and next month. You would then be obligated to sell your shares at $140 if the buyer of that right, that option, chose to exercise that right. If it doesn't go above $140, the buyer of that call is not going to exercise their right, so the contract will expire. You keep your $540. If the stock price does go up, they buy the shares from you at $140. You bought them at $130 though, so you make $10 a share, and guess what? You still keep that $540. If your shares get called away, you buy back in, rinse and repeat. Now, if you're selling calls on stocks that are already paying dividends, you're only adding to the income on your portfolio. And I just noticed that was ridiculous. I shouldn't have used 140 as the example because Apple's already above 140, but instead of 140 being the example, you could look at 145, you could look at 150. And these calls right now are priced at $3 or $1.68. Obviously, the higher strike price you choose, the less that's going to be worth for the calls. Okay, and finally, I want to give you guys a bonus here because using margin on a stock portfolio increases your risk, and selling calls, while it does bring in income, it limits your upside potential. And so if this sounds a little bit too risky for you, that's where this bonus comes in. This bonus is buying puts. Now, puts are the opposite of calls. It gives the buyer the right to sell shares at a specific price. Now, you're already producing more income by selling calls. So if you turn around and take the income, just the income that you got from selling that call, and you use that amount to buy a put, that's like buying insurance on the price of your stock falling, and you didn't have to pay any money out of pocket for it because you used the income that you got from selling the call. This is called a collar. This strategy is called a collar, where you sell a call, bring in income, and use that income to buy a put. That gives your stock a ceiling in terms of capital appreciation, and it gives it a floor in terms of how far it can fall, because you as the buyer of that put will now have the right to sell that stock at that price during the time frame of that contract, which means that in the event of a massive liquidation, a stock market crash where everything in your portfolio falls, you don't have to worry about getting a maintenance call where you all of a sudden have to deposit a ton of money or sell out all of your stocks at the bottom because you are leveraged up in your account using margin because you have puts protecting your account from that fall. And so you boost your dividend income by levering up your portfolio with some high-paying dividend stocks, and then you put a floor underneath the value of those stocks by buying puts, and you don't have to pay out of pocket for that because you're selling calls, basically putting a ceiling above your stocks, doing the collar strategy, and during the lifetime of those contracts, your income is essentially risk-free. Now, there's always more than one way to skin a cat, and using one or multiple of these strategies judiciously can provide rocket fuel for the income on your dividend stock portfolio. Select better stocks that pay higher dividends, lever up with margin, sell calls, and buy puts. And again, I need to emphasize, it's not a recommendation. It's not advice, because at the end of the day, I'm just some guy that you found on the internet, and I do not pretend to know what the best use of your money is. After all, I'm not the government. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.